All right, good to have you with us on this Monday morning. We mentioned the U.S. futures pointing to a positive start. It's going to be a busy week, as we mentioned, on both the earnings and central bank front. And for the Canadian markets, the TSX is coming off its second winning week in a row. We've started to see some of those lagging sectors pull up their socks a little bit. And we already mentioned that the Dow, for example, had rallied for the last 10 sessions. So the laggards of 2023 picking up some steam. But we mentioned that there are some signs of a cooling economy as we go through the year. And we'll get some GDP data in this country as we move through the next few sessions. I want to bring back Karl Schamotta, he's Chief Market Strategist, Corpay, to talk more specifically about Canada. How are you assessing the situation in this country right now?
It is interesting. We had almost a false dawn, I think, in the Canadian economy in May. Surprising robustness in growth levels, and that was led by the fact that you did have that you did have a rebound in the real estate market. You had strong employment numbers, strong consumption, all of that feeding into overall growth. When we look at the GDP print, the early estimates suggest that you're going to see a relatively robust rebound from the numbers in April. However, the preliminary estimate for June is likely to point to more softness, right? And so why are you going to see more softness? Very likely because that rebound in the housing market has sort of faded off. We've seen a bit of a slowdown in activity. And at the same time, you had all of the sort of wildfire related disruptions to the energy sector, right? So, that business investment side might slacken off, exports might slacken off a bit at the same time that you have a bit of a slowdown in the core consumer engine in the Canadian economy, which is largely driven by what's happening in the housing market.
We'll get that data on Friday. The reading is for May. You mentioned we'll get an early look at June, but all of that still is, we're on the doorstep of August here. And I guess for the Bank of Canada, which has already been quite aggressive in raising interest rates, where do they have to pinpoint their focus at this point? We are going to, by the way, get Canada's relatively new version of Fed minutes, the deliberations from the most recent Bank of Canada decision. We'll get that this week as well. Maybe that'll give us a little bit of more color on what their thinking is going forward.
Yeah, it's funny in Canada, right? We're so often driving and using the rearview mirror, right? We're looking at what happened historically to figure out what policy changes might come in the future. The reality here is that markets are overwhelmingly convinced that the Bank of Canada is now on the sidelines and for a prolonged period of time, right? The question at this point is not about what happens in this calendar year. It's about what happens in 2024. Are we looking at a Canadian economy that slows more dramatically and then compels the Bank of Canada to match the Fed when it begins cutting, right? So there was an assumption for a very long time that the Bank of Canada would lag the Fed, that the Fed would begin cutting really aggressively, and the Bank of Canada would follow at a delay and also cut by less than the Fed did. And that assumption, I think, is going to be challenged. And the main reason here is that we are seeing that, that softening in the labor market here in Canada, probably progressing a little bit more quickly than it is in the U.S. So you're seeing, the number of job vacancies come down. The employment number on Thursday is going to be kind of interesting for that as well. The job vacancy number in the survey of employment payrolls and hours. And all of that sort of combines to suggest that what the Bank of Canada is going to be seeing by the time it makes its next decision is a bit of a slowdown. And so that is going to compel them to stay on hold. I don't think the minutes are going to dramatically impact our perception of where policy is going to be set in September, October.
What does that mean for the Canadian dollar, which you would think would be ripping higher with all these interest rate hikes, and at a time when it felt like the U.S. dollar narrative was shifting? But you already alluded in our conversation this morning, maybe don't fight the greenback, basically?
That's right. The big deal here is that the U.S. is still the cleanest dirty shirt on the global economic landscape, as it were, to use a cliche. But when we look at what's going on in the global in the global economy, right, the U.S. economy is still growing relatively rapidly. Employment conditions are fantastic. Consumer balance sheets are not that strained, particularly relative to countries like Canada. And all of that means that the U.S. is able to raise rates and hold rates for a prolonged period of time, whereas here in Canada, we're facing very deep vulnerabilities. When you look at the euro area, Japan, China, virtually everywhere else in the global economy, you're seeing signs of an incipient slowdown. And so what all of that is doing is bringing capital back into the U.S., and it means that the Canadian dollar is really struggling to push higher. We keep seeing like that repeated sort of attempt to push a couple of cents higher and break through resistance, and it's not happening. It just kind of keeps getting stonewalled. And I would suggest that that's a dollar story. It's not about Canada, at least not in the broader sense. It's certainly about the fact that Canada has deeper vulnerabilities, but it's really about that fact that the Fed and the dollar are steamrolling ahead. And I wouldn't bet against that anytime soon.
Just a final question. We mentioned these reports and our Bloomberg colleagues reporting on a possible cabinet shuffle in Ottawa. I wonder how the story of the economy and where it goes from here maybe factors into the federal government's thinking going forward.
Yeah, so clearly they're going to try to move a little bit to the right here, or a little bit more centrist, much like we're seeing in the U.S. They're going to look to campaign on an economy that is relatively strong, but also sort of downplay worries across, Canadian households about inflation and government spending, right? And that is the real big concern. Like, I think it's going to be very challenging for Trudeau and for Biden in this next electoral cycle because of that big ramp up in spending that Canadians directly connect, erroneously or not, with the inflation that they've seen in their everyday lives, right? They do think that big burst in government spending and in immigration is feeding back into the costs that they're paying at a household level. So what you're looking at is not necessarily a shift in actual policy direction, but it's in how they communicate what they're going to do in the future. They're going to try to come in with, how shall I put it, a platform of fiscal rectitude, right? They're going to try to come in with a message that says that they are going to move policy settings back to more normal levels, and avoid the big sort of splurges that many Canadians are probably rightfully wary of at this point.
All right.